In this lesson, we'll be going over a comparables valuation model. The first page in this spreadsheet is comps, or company comparable inputs. In the first column, we listed all the company names: Nike, Adidas, VF Corp, Under Armour, and Puma. Next, we put the tickers for each company. In the third column, we have the last 12 months date, which will be the date of the most recent quarterly report. Then stock price, where we list the stock price of all the companies, and above there we have the date of when we took the stock prices. Next is basic shares out, which can be found with a simple Google search and represents the amount of shares that each company has outstanding right now. Diluted shares outstanding is a formula and will be automatically generated once you enter the amount of basic shares out. The difference between basic shares outstanding and diluted shares outstanding is diluted shares includes diluted securities such as warrants, capital notes, or convertibles. Market capitalization does not need to be inputted, as it is also a formula like diluted shares. Market capitalization is simply diluted shares outstanding times the stock price. Now, to find the net debt of a company, we will look for cash and all the company's liabilities. This can be easily found on Yahoo Finance in the financial section and the balance sheet of almost any company. First, we will look for cash and cash equivalents, which is on the balance sheet, usually the very first thing. And then convertible debt, conversion price, preferred stock, non-convertible debt, and minority interests are all the liabilities which can be listed. If you don't find these listed in the balance sheet, you can go to the company's reports and you can find them there, even though mostly the only inputs that you would need are cash and non-convertible debt. Once we're done with net debt, you can move on to enterprise value. Enterprise value is simply the net debt plus the market capitalization. Next, you'll be finding revenues, historic revenues, and predicted revenues for the future. The first column, which is CY015A, means calendar year 015 or 2015 actuals. These are the actual recorded revenues for the company in 2015. LTM stands for the last 12 months, which refers to LTM in the beginning, which is the last 4 quarters that were reported and the revenues added up for the last 4 quarters. CY16E stands for calendar year 2016 estimates. Same thing with 2017 estimates. These are what the analysts think that the revenues for each company will be in 2016 and 17. EBITDA, which is earnings before interest, tax, depreciation, and amortization, net income, and EPS, which is earnings per share, can all be found with a little bit of searching around on the web. The last input we'll be finding in comps is the 5-year EPS or earnings per share, CAGR, which stands for compound annual growth rate. This can also be found with a simple Google search on the web. Next, we'll be learning about the multiples page of the spreadsheet. Everything from company name to 5-year EPS, CAGR is a formula that pulls the numbers from the comps sheet. Once we get to enterprise value multiples, we divide whichever column we're looking at by the enterprise value. For example, for the first column, last 12 months revenue, in the first box, which is for Nike, we put in an equation that divides the last 12 months revenue of Nike by Nike's enterprise value, and that's where we get 2.8. And we do the same thing for all the other boxes, so on, for calendar year 2016 estimates, calendar year 2017 estimates, last 12 months EBITDA, calendar year 2016 estimate EBITDA, and so on. For the equity value multiples, we divide the earnings per share estimates by the current stock price. If you look all the way to box AY13 and AY14, you can see that we have the words outlier there. That's there because company Under Armour and Puma are much smaller than Nike, Adidas, and VF Corp. We have them as outliers because they're so small. Their numbers can jump around with much higher percentages but move much smaller amount, which can affect the equity value multiples, making the averages below not as accurate. Once we found all our enterprise value multiples and equity value multiples, a couple spaces under, we find the highest value of each column, the mean value of each column, the median of each column, and the low value of each column. All the way to the bottom right of this sheet, you can see where we compared the current price of each company's share to the actual value of their shares and how far off the price is from the true value of the share.